Tomorrow is CPI numbers for August, and in this video we're going to go over a lot. We're going to talk about the bullish positions that I opened today on QQQ as well as Tesla. We're going to recap a couple of trades that I closed as well. We're going to go over the outlook for CPI data. We're going to look at this bullish case from an analyst, as well as where I think the market's going to be going within the next couple of weeks. If you guys don't know who I am, my name is Peter DiCarlo. I've been a full-time trader for the past 8 years, and I run a trading community with over 12,000 members. If you guys want access to that community, as well as all of my trading resources, the link is in the description. And if you guys want access to all of my personal trades, that will be the second link in the description, which is free. So let's take a look first at August CPI forecast. So for those of you who do not know what CPI means, it's Consumer Price Index, or inflation numbers. Now there's different types. There's core CPI, which I can do a full standalone video if you would like me to, talking about the differences, but they take away some things that they consider too volatile to put into that number. And the monthly number that comes out shows us at what rate inflation is worsening or becoming better. The goal, obviously, is that we see CPI decrease so that we can continue to quantitatively ease and hopefully stimulate the economy and get ourselves out of a recession. This article, this Lauren Solberg, says August CPI forecasted is showing to have good news on inflation with higher gas prices aside. Inflation is still well above the Fed's target, but price pressures are slowly moving in the right direction. CPI for August is forecasted to show that after a summer of better news on inflation, consumer price index in the US is rising at half the pace that it was a year ago, even with a jump in gas prices. Yet the economy remains stronger than most had expected. Investors and the Federal Reserve will most likely have to wait a while before inflation returns to an acceptable long-term level. Core CPI is improving. So she's saying for August report, the CPI is expected to show 3.6% increase in inflation from year-over-year levels. That is well below last summer's peak reading of 9.1%, but is still higher than last month's reading of 3.2%. And this is very important, guys, because if we see CPI come out tomorrow and the major headline is that we're down year over year, that's not going to matter. We're already expecting CPI this year to be down much lower than it was year over year. But if we see CPI come in at 3.8, 3.9, or 4%, that will not be a good sign, because what we don't want to see is a month-over-month increase in core inflation over the past 3 months. That would show that we're starting to get a move back up, and it could require more tightening, less easing, and we might have to see the Fed become more hawkish. So something to note, like we said earlier, is that core CPI does exclude volatile food and energy costs, as expected to show an annual increase of 4.3%, down from 4.7% in July. So the Fed is, quote, data dependent. Core inflation continues to come down gradually, as the Fed is expecting, and then they believe that they will leave rates where they are. But if monthly core inflation starts to tick back up, this could be a problem, like we said earlier. Now, where does this leave us with Tesla? Because I did end up taking a position on Tesla today, and the targets that I had drawn out for these bigger time frames was up here at $280, which would fill the gap back up to $290, and from there up at $300. Now, to explain the position that I took this morning, we're going to have to talk a little bit about trading with scripts and about what most would probably call quant trading, but I just call pattern trading. If you're someone who runs their own trading bots or scripts, you will know that when you're looking at back-tested results of whatever your strategy or pattern might be, that in order for you to actually get that number that you would rely on, whether it be accuracy rating, average return, total return, you therefore have to take every single position that would come your way. And so the position that we're looking at here is a bullish shark on the 1 minute. Now, this is not how you would technically play a bullish shark pattern, but we know statistically that 74% of the time we'll move our way up to this target of about $280, and then 25% of the time we'll drop down to $262, where our stop loss is. Now, ultimately, this RVR is not the best, even though we have a high success rate. So what we do is we wait to see a drop to a better area where we start to get a better risk versus reward. So now that we're trading down at about 270.33 and we know we have a T1 success rate of 72%, we now have a 1-to-1 RVR with a 72% success rate, which statistically, maybe not today, but over the long run will do more good for your account and for your long-term return than nearly anything else, because all you have to do is stick to your plan. To have a win rate with that type of success with an RVR of 1-to-1 is something that a lot of people dream of having. So in this instance, I ended up taking a position, and all we do is allow it to play out. If we end up hitting our stop loss, it's whatever. If we end up hitting the take profit up at 280, then that's great. We started to see an inverted head and shoulders here earlier. It looked like maybe we would run back up to 278, but we didn't. We continued to sell off, and in this instance, what we're doing is just continuing to hold and wait. Do I really personally want to swing a position like this through inflation? No, I think that inflation is going to be higher month over month. But in order for me to rely on my data, to rely on my strategies, to rely on my win rate, and to rely on the numbers, which is extremely important because our goal here as investors is to remove our emotions from everything. Now, I'm going to be doing a live stream with my premium group in the Discord community on Thursday, going over everything, a full masterclass on how to set up your bots, how to script, how to do like the most basic coding known to man, because it's very, very simple. And I'm going to be releasing that for free to you guys on this channel probably sometime next month. Now, as far as position sizing, I went with calls expiring next Friday. This was with less than 3% of my total account. And the reason that I trade with such small position sizes is because in this instance, looking at the past month, we're up 3.6% on shares if you would have traded this, which isn't crazy. It's not a lot, but it's very consistent. And this is also a month where Tesla's been very volatile and has also dropped a bit in the prior couple of weeks. If you were to look at this, we have a lot of trades, but you have to take every single trade that comes your way. You can't cherry pick because one massive move, let's say CPI is great tomorrow, Tesla rips 6%, and you missed it because you wanted to just not deal with the risk, which I understand, it's very important, but that could be a huge discrepancy in your total return over years and years if you miss a couple of those massive days. It's the same thing as an investor. If you miss some of the biggest days for Tesla, like you missed yesterday, if you're a long-term investor, that could have a substantial difference on your compounding returns over the next 30, 40 years, all because you were worried about it. Instead, what you should do is not throw your entire portfolio into everything that you have, but actually take it and say, okay, if I can trade with 5% of my account per position, that means that I can hold X amount of positions every single day, which means that I can trade multiple tickers. Because look, I can use this trading script right now on Tesla. In the past month, I would have made a 3.6% return. But if I also would have had enough capital and traded with such small position sizing that on top of that, I could add TQQQ into that, maybe Amazon, Meta, whatever other ticker that you wanted, you could be running multiple tickers, hundreds of trades a month, which can be a lot for commissions. But the whole point is that you're diversifying yourself between those positions. Because look, TQQQ was a 29% return. So at the end of the day, for me, I really enjoy small position sizes because I think that it allows me to play my patterns out in conclusion, allows me to hold multiple positions at one time. Now, the other thing we're going to talk about is TQQQ, which I also have a position on because we have the same bullish shark setting up. In the past month, this was an 82.93% success rate, so very high. Total return 29%. Target is up at 42 and stop is down at 39.60. So if tomorrow CPI numbers are great and we rip, awesome. We make money. If the numbers are crap, we don't cry. We don't get upset. We're not like, oh my God, like didn't bet the house, so we don't give a shit, right? At the end of the day, we're just going to trade what is in front of us. And if statistically tomorrow we are winners, cool. If the numbers don't play out in our favor, it's whatever. Hope this video helped, guys. Thanks for all the support. Check out our Discord community down below, and I'll see you guys next time. Peace.